Welcome, and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. On the program today, we're going to be discussing something a lot of us like to talk about, but sometimes feel embarrassed about what we do know, and that is when it comes to money and how to manage it. After all, many of us want to become wealthy because we believe it brings us the kind of freedom, especially when it comes to time and convenience, of being able to make the choices that we would like to make. And certainly as you approach Beyond 50, as many of our listeners have, they also want to look for something that will bring them security, for instance, so that way they'll be able to anticipate some of the things that might come in their future that might cause a little bit of financial strain in case they don't happen to plan correctly when it comes to this. On our program today, we're going to be learning about ways that we can use investment strategies, principles, and lifestyles of more than 200 everyday people with middle-class backgrounds whose investments have made them millionaires. Our guest is joining us, who is author of several books, including his newest bestseller, 8 Steps to 7 Figures. It's the investment strategies of everyday millionaires and how you can become wealthy, too. I'd like to welcome to the Beyond 50 radio program today our guest, Charles Carlson. Charles, thank you for joining us here on the program today.
Yeah, thanks for having me.
You bet. Now let's talk about some personal characteristics among these people that you feature in your book.
Well, a number of the personal characteristics, they're married, and their marriages tend to last. Only about 1 out of the 5 people that I talked with had a divorce. On average, they've been married for about 32 years. And things like marriage and divorce are important because they create kind of shocks to your finances, and that's one of the important steps in the process of trying to develop a 7-figure portfolio is really avoiding those shocks. So one of the common threads was that they stayed married. Another common thread was these weren't families that had 8, 9 kids. The average was less than 2 children per family. Again, kids tend to be expensive, and I'm not necessarily advocating small families. I'm just providing some characteristics of these folks. Another that was interesting is that the people tend to stay at their jobs. On average, the people that I worked with had only had 3 jobs during their working career. I think that's versus an average now that's in double digits, and they had been at their current job on average for about 19 years. Again, so there's this kind of theme of consistency and discipline and predictability built into their financial programs, and from that allow them to maintain kind of a consistent investment into their retirement accounts, and also avoided kind of these shocks, these changes, which cause people to kind of stray from a disciplined investment approach.
Now, you've certainly been in the financial industry a long time. What would you say, obviously we've talked about some personal characteristics of these people, but what was the single biggest reason you think it was behind their success?
Well, 2 really. One, they got started, and I know that sounds almost ridiculous to say, but the biggest single roadblock for people in terms of building wealth in the stock market is they never start. They always have a reason. The market's too high, or the market's going to fall, or I don't have enough money, or I'm too young, or I'm too old. There's a million different reasons, but the fact of the matter is these people started, 1, and then they continued, 2. They took advantage of the power of time. And that was really, and 3, they were willing to kind of delay gratification, which is something that seems to be increasingly more difficult for a lot of people to do. They were willing to say, listen, I know this isn't going to happen overnight. I know this is going to take me 15, 20 years, in some cases 30 years or 35 years, but I'm willing to kind of delay the gratification because I know at the end of the day this is going to be a good thing. And so that infiltrated their spending habits, for example. All of these people, or many of them that I talked with, tend to live well below their means in a sense of what they could own in terms of material goods, because that wasn't as important to them to having a secure financial future. So, getting back to your initial question, I think it's 2 things. It's 1, they got started. 2, they maintained the discipline and consistency of investing over a period of time, and that paid dividends for them once they got to retirement.
You remind me of the gentleman, Famous Amos of Famous Amos Cookies. When you talk about getting started, he says, that people a lot of times, they will research something to death before they ever get started. It's almost as though they're looking for that safe, secure step that they need to take. But even though we hear about things such as taking risk when it comes to investing, what you're also suggesting here, it sounds like, too, is these people not only got started, but they also got started at a pace. They also learned how they can begin to manage risk. Would you say that'd be a key characteristic as well?
Oh, absolutely. The investment process is very infectious, and once you get started and you start putting money away and you start figuring out how you can buy certain investments, what happens is that while you may not be kind of rewarded overnight, you're going to get involved in the process, and then what happens is you start accelerating that process, and you start looking for other areas where you can get money. Maybe, the $5 a day that you're spending at Starbucks, or the whatever. Those sorts of things people start to kind of think about in terms of, boy, I could put that into investments. And one of the themes I talk about in my book is that this whole idea of spending begets more spending, and if people really understood that, they may control their spending a little bit better. Typically, when you buy something, you're going to have to spend more to support that thing you bought, whether it's a car, whether it's clothing to clean them, whether it's a boat, and virtually anything begets more spending. So it becomes very difficult if you are somebody that is very aggressive consumer to really save anything. And these people basically said, listen, I don't need the latest and greatest things. I'm content with what I have, and more importantly, I can see the benefits at the end of the rainbow here if I continue this disciplined approach. Discipline is very important in this process, and these people managed to continue an investment program. They weren't trying to hit home runs. They weren't chasing the latest greatest investment fad. They were just buying good, and for the most part, good, solid blue chip companies that everybody, there aren't any secrets there, and holding them and buying more over time, and not trying to trade the market to try to pick the times to get in and out, because that typically gets you into hot water. And they were willing to say, listen, these are investments. I'm going to hold them. I'm going to add to them. And over time, this is going to serve me well, and it served. It did serve them quite well.
I like how you say the fact that they, A, they get started, B, they don't look to find the next sexiest, trendiest thing. I mean, how often have we heard, gee whiz, if I had just invested in Microsoft or the Intel Corporation? I don't know how many times you're going to hear that from people, but you have to understand, what did you know about that industry at the time that there was an initial public offering? What did you really know about that, right?
Right, and the thing is, it's and again, this is kind of a mindset people have, which I don't think serves them very well. I mean, who would have known about Microsoft at the IPO and then bought it at that point? I'm sure there were some people did, and if they did, and they've held on to it, then they're awfully glad they did. But there are people who bought Microsoft 10 years after the IPO that have bought it and held it and have done quite well, or 15 years later. I mean, the bottom line is you don't necessarily have to be at the, quote, ground floor, and you shouldn't avoid a stock because you weren't in on the ground floor. And you shouldn't avoid a stock that may have already done well in the market if over the next 10, 15, 20, 25 years it could continue to put up maybe not as strong a returns as it did in the first 5 years of its existence or 10 years, but still returns that will, far and away outbeat what you're going to get at your bank on your savings account or your passbook, or on your checking account or on a money market account. And so, and these people did that. They, in most cases, they were not buying exotic investments. I mean, when you look through their portfolios, they had a lot of stocks that people would recognize. A lot of blue chips, a lot of stocks in the Dow Jones Industrial Average, and through holding them, reinvesting the dividends, putting more money in over time, they managed to build seven-figure nest eggs.
If you could, for our listeners, go ahead and describe at least 3 of the 8 steps that you talk about in your book.
Sure. That I mentioned one already, and it's probably the most important, is, start now. Even if you're, I covered some people in the book that didn't start investing until their 40s or 50s. And, they stayed with it, they put money in, and lo and behold, they became millionaires. So I think you got to start now. I think Rule 5 is invest every month, no matter how small the amount. You need to be putting money in on a regular basis, regardless of the size. And again, don't worry so much that it may seem small in the beginning, because this whole thing is going to become very infectious, and you're going to find more money. I think step 6 is very important. It's buy and hold, and hold and hold. A lot of people try to think they are smarter than the market. They can time the market. They can get in and out of the market and avoid those downturns. And the reality is, you may get lucky a time or two doing that, but it's very, very difficult to do over time. And that's the key here. This is a process that's going to take more than 12 months, more than 24 months, more than 2 or 3 or 4 or 5 years. And if you are somebody who thinks they're going to be darting in and out of the market, or they get shaken out of stocks, or because the market goes down and then they're going to get back in, you're really kidding yourself. Again, it's kind of like Las Vegas. The first time we're going to Las Vegas may luck out and win some money, but I guarantee you, if you go to Las Vegas and you try to do that 15, 20 times, they're going to get ground into the ground, and the market will do that to you. And furthermore, the one time that you mess up on your market timing can undo all of the positives that you got from successfully market timing. So the bottom line is, really take a long-term approach with your investments that you're willing to buy and hold them. Another factor that benefits from that is that it's typically a very tax-friendly way to invest. So you're not incurring the wrath of Uncle Sam every year and having to pay taxes on your realized gains. And then finally, and we mentioned it briefly, try to limit shocks to your finances. Shocks can be, divorces. Divorces are very expensive. Having, job jumping around, so you're not getting the opportunity to really build up a 401k plan that may be available to you at your particular place of employment. So avoiding those sorts of shocks, those big life-altering changes that will cause you to really stray from a regular investment program, that's something that people should avoid, and the people that I talked with did for the most part.
Now, you certainly talk about one important ingredient, and I think this stretches back to even younger people, the power of time. There's nothing greater than compound interest and the time to actually watch it compound.
Oh, absolutely. And that, time is, fortunately, and again, I know your show is not necessarily geared towards somebody who's 20 or 25 years old, but the younger you are, the more you have of the most important, valuable characteristic of an investment program, and that's time. Just some simple numbers, for example. If you start investing at age 35, you need to invest $650 a month to reach $1 million by the age of 60. So if you start at 25, you can reach $1 million, assuming a 8 or 9% return on the market by investing $650 a month. If you wait 10 years and you don't start till 45, you're going to have to invest $2,200 a month, or more than 3 times what you would have invested 10 years earlier, in order to get to $1 million by age 60. So, the sooner you can start, even if it's seemingly small amounts of money, you're going to harness that power of time, and it's going to just pay off. Again, it's not going to pay off in 12 months, 24 months, 36 months, but, you start looking at that over 10, 15, 20, 30 years, it's going to pay off royally. The other thing is, even if you don't get started until age 45 or even 50, you look at an actuarial chart these days, and your typical 50-year-old is going to live another at least the actuarial charts will say another 25 to 30 years. That's a pretty long time, and certainly long enough to accumulate wealth in the market. Now, granted, you may have a little less to invest because you need money for cash flow to pay your bills and things like that. But I see it all the time where people use the excuse, "I'm too old, I can't do this," and that's hogwash, quite frankly. So, I mean, the power of time, the beauty of time in an investment program, quite frankly, is that if you maximize the power of time, you don't have to be that smart about anything. I mean,
that's right.
which is nice. I mean, shoot, it kind of, you don't have to be a genius to do this. You harness the power of time, and you don't try to hit a bunch of home runs. You swing for singles, and you do it over a long period of time. You take advantage of market declines by investing every month. It's going to work. I can guarantee it's going to work. And I know some people will say, "Well, geez, who knows what's going to happen in the market over the next year or two or three or four?" And the answer is, well, nobody does. I mean, I can give you some guesses, but the reality is I don't know for sure. But I can tell you that when you go back and look at rolling 20-year periods in the stock market since 1926, where you look at if investors would have held, investments in that 20-year period, I don't think there's been a 20-year period since 1926 where you would have lost money. So the longer you're willing to look out your investment time horizon, the more likely you are of being able to make money in stocks. And again, I talk about individual stocks. You can achieve the same things through, if you prefer to use mutual funds or exchange-traded funds. If you feel safer doing that, that's fine. My point is, though, you need to take advantage of putting money into the stock market and being willing to have that money in there over time and being willing to add to it. Again, you're not going to get rich overnight, but you should do quite well over the next 15, 20, 25 years. And that's what these people did.
Now, tell us where the listeners can find out how to go about getting your book, a website, things like that.
Sure. The book is available on Amazon.com. That's probably the easiest place to go get it. So if they go to Amazon.com, and I think they can order there, and I think they can order actually older copies of it from other individuals, and so it should be pretty inexpensive. And again, the name of the book is 8 Steps to 7 Figures.
Mm-hmm. Very good. Thank you so much for joining us here on the program today and sharing this. I mean, it's funny when it comes to investing and you get the right people, for instance, on our program who actually share ideas, and you realize, this isn't that hard. It doesn't take rocket science. It just takes, as you said, get started. Be sure that you're consistent. You're very disciplined in what you're doing. Hopefully you can leverage time, especially, for a lot of us approaching midlife. We got to get concerned about that, but nothing's worse than not getting started. Try not to put yourself in a life-changing situation that's going to cause a lot of that to drain, as you were talking about earlier, divorce. You seem to see a lot of that among celebrities, for instance, and you're oh boy, So there's just really a lot of factors to consider, but there are a lot of things that are pretty much under your control.
There are, and I think, as you say, people tend to kind of make this much more complicated. Just one characteristic of the folks that I talk to, my everyday millionaires, more than 85% of them, had no investment experience prior to starting their plan. So they didn't know anything, but what they did come to understand is that I may not know anything, but A, I need to do this, and B, I know that if I do it and do it sooner rather than later and start the process, that the power of time is going to work its magic. So it can be done. It isn't rocket science. There are very simple rules that anybody can follow. And the beauty is now there's a lot of different ways people can interact in the stock market, whether they're buying individual stocks or buying mutual funds, et cetera. And the cost of that interaction has never been cheaper for people, whether it's low trading fees or buying through dividend reinvestment plans or buying index funds. It's never been cheaper to interact in the market. It's never been easier for anybody, regardless of the size of their pocketbook, to do that. And so to be able to accomplish this today versus trying to do it 30 years ago is going to be a lot easier. It's going to be a lot cheaper. It's going to be a lot more customizable to your own investment and financial situation. You just got to get started. So hopefully people will.
Very good, Charles. Thank you so much for joining us here on the Beyond 50 radio program.
Thank you.
We want to thank you, the listeners out there, for tuning in. You can also discover more by visiting us at beyond50radio.com. That is the number 50. We do encourage you to sign up for our weekly e-newsletter so you can stay up to date on what's going on in the world of Beyond 50 as well as our upcoming shows. I'm Daniel Davis. Thank you for tuning in. This is the Beyond 50 radio program, and remember, live your day past halfway.